Breaking news as JP Morgan Chase issues a terrifying warning on the Trump housing market. And we're going to discuss the reasons for the warning as well. Now, in addition to that, we're going to review the new report on home buying regret and the overwhelming amount of people that regret buying a home, trapping themselves in a financial prison. And we'll end discussing whether or not this is the end of rate lock and the golden handcuff phenomenon. Now, before we begin, good morning, Mitch. Happy Thursday, sir. How are you?
The week's almost gone, and the market's doing what it's doing, and we'll get into this JP Morgan issue here in a second, but I'm ready.
Hopefully after this weekend, our school will be up and running. You guys stay tuned for that. We're super excited to announce that. And don't forget to like the video real quick. Please, you guys, share this video and comment below on what you guys are learning. Let's get started now. Home ownership in the United States has become a damned if you do and damned if you don't situation, especially for the generation that has been kept off the property ladder the longest, which according to them are millennials. A majority of 67% of Americans born between 1981 and 1996 who don't yet own a home regret not buying one when prices were lower. But remember all the bidding wars. Remember you had to waive contingencies. It was extremely unhealthy. Now, this is according to a November 2024 survey of 1,000 millennials who plan to buy a home in 2025. At the same time, 82% of millennials who do own a home regret at least one aspect of their first home purchase, the survey found. So we got about almost everyone regrets buying a house. And I bet you the people that are using math to purchase, they don't have as much regret. I bet that regret is probably under 20%. But the people that are using their emotions, that's what you see right there. Why it matters. Millennials' homeownership dreams delayed and frustrated by 2 financial crises in less than 20 years. And that's funny. That is true. I've been through 2. Is now being thwarted by the affordability crunch plaguing the U.S. housing market. Despite a recent dip in sales due to the fact that so many home buyers have been squeezed out of the market over the past few years, home prices are still rising across the country. The median sales price of a home in the U.S. was $427,388 in December, according to Redfin, and that was up 6.1% year over year, again, according to Redfin. Mortgage rates, despite recent rate cuts from the Federal Reserve, are still hovering around the 7% mark because, remember, they follow the 10-year Treasury, not the federal funds rate, which the federal funds rate is what the Fed has been cutting. Even for those who have managed to buy a home, things don't get easier. The cost of housing is surging in the U.S. with rising homeowners association fees, property insurance premiums, and of course, skyrocketing property tax. What to know? For a majority of millennials, it is probably a surprise that the same dream they spent years striving might turn into a bit of a nightmare once it comes true. At least it did for 82% of people. A majority of 81% of millennials told Clever Real Estate that they are planning to buy a home in 2025, and they are confident they won't regret it. I wonder why they're confident. Is it because they're using the math? Did they take the course that we're offering for free? Is that why they're confident? Tell me below. Is that why you're confident if you're one of these people? However, about 82% of millennial homeowners already have some regrets. That was fast. 19% say that they are outgrowing their first home too quickly, with 18% realize their home lacks their desired features. 17% compromised on location for their home to fit their budget. 17% had bad neighbors. I hate that one. 15% regret not knowing more about home buying, and 15% underestimated property taxes and homeowners insurance costs. Additionally, 14% said their home is in a bad location. 13% regret the fixer-upper status. 13% now think they rushed the process, with another 13% found that the upkeep of their home is too expensive. Another 11% that the rate's too high. 11% that home ownership is too costly. And 10% say that their mortgage is also too costly. That's all the same thing, essentially, anyways. Now, what people are saying, I'm a millennial household. I either have to allocate more money to savings or reduce my expectations. It's the brutal reality of supply and demand. Millennials are saddled with higher real costs of college than their parents and with higher housing costs. It's going to continue to be bad for several years. Almost all of the respondents, or rather 96%, have concerns about buying a home. Let me read that again. And this I'm proud of. the people that answered this survey, almost all respondents, 96%, have concerns about buying a home. 44% saying that they are worried about finding an affordable home. So 44% finding an affordable home. And that was only 35% in 2024. Now, among the 97% who faced barriers to homeownership, 52% think homes are too expensive, 48% think that interest rates are too high, and 44% find it too difficult to save for a down payment. And honestly, if a lot more people would actually take a step back and really ask themselves, so what does it mean to save a down payment? I think it would be higher than that, because remember, you don't want to go broke buying a home. You need your down payment plus savings. You can't use all of your savings. You shouldn't, at least. What happens next, according to this article? Experts expect more inventory to reach the U.S. housing market this year, softening price growth and offering home buyers more options. So that's it. So that's all they have about the conclusion. They're not talking about credit, income, assets, or how you should never, ever use your emotions when purchasing real estate. Now, Mitch, okay, being that roughly, according to that survey, 82% of millennials have regret in purchasing their home. And honestly, I'm really happy to do a housing market video with you. Usually I do these solo, so I'm happy to get your perspective here. But what does that tell us about the state of the housing market?
Completely coincidental to this article that Travis just read. Part of the document that I've been putting together for the FBI and the SEC initially laid out the home ownership versus renter perspective. And it used to be in the United States, the American dream was to own a home. Mathematically speaking, that is no longer the case. I was going to put it in the document, but Leslie said it's too sophisticated. It requires too much effort to explain it. So I'm going to try here to do that shorthanded. But the bottom line is the line touches. Now the line touches itself. So the difference between home ownership versus renting, based on the expenses per home or the expenses per multifamily, the lines now sit on top of each other. They're neck and neck. Well, that proves the destruction of the American dream of home ownership. Where did it go? What has created these two lines to now touch? Well, that's the real estate tax. That's the ramifications of all the fraud. The real estate tax exists to cover off the fraud that has been created by the fraudsters, which are the taxing entities, which own the school districts, which own the central appraisal districts. That's where the damage is coming from. And the net result of that is $450 billion being stolen in 2024 as a direct result of the $21.25 trillion of overvaluation created in the last 5 years by the central appraisal districts. That is fraud. That fraud has now put these two lines, one on top of the other, to the point where the American dream is no longer achievable. And that must be reversed. And that ties 100% to that article that Travis just reviewed.
I'm going to go out on a limb here and say that it has never in the history of the United States housing market been a more toxic time to buy. And I'm not talking about just price and just payment. I'm also talking about the misinformation out there. Oh, I forgot. I'm not supposed to use that word. That's what the authorities use to discredit us. I forgot about that. But regardless, Mitch, let's go into the next segment of this video, which is JP Morgan's terrifying warning about the Trump housing market. This article came out February 11th. Trump housing market warning issued by JP Morgan Chase. And before I continue, pause the video, comment below, and let me know what you think they're about to warn us about. Because I was caught off guard here. President Donald Trump's, and here it is, immigration policies. Remember when we read that Harvard report on immigration impacting the housing market? They stated in the years to come, the only household growth is going to be from immigration. So this is an interesting take on that very thing. President Donald Trump's immigration policies could put additional strain on the U.S. housing market, according to JP Morgan Chase. By reducing immigration and lessening demand, Trump argues, and by the way, this just says immigration. It doesn't say illegal immigration. I think that they're referring to illegal immigration, not just immigration. I don't know why they're not putting the illegal there first. And what I mean by illegal is like you don't have the paperwork, right? I'm not saying good or bad. I'm just like you don't have the paperwork. That's it. So either you do or you don't. Trump argues that the housing cost can be reduced. The head of Securitized Products Research, John Sim, in a note published Monday. It's not that simple, though, he continued. Approximately 30% of construction workers are immigrants, illegal immigrants. So there could be complex implications. And if they are there illegally, then maybe those implications are the employer being fined. I'm not sure. Maybe. Why it matters. The U.S. housing market is in serious turmoil, with supply constraints resulting in higher costs for buyers across the country. Beginning with the blank 19 pandemic, home prices have soared to historic highs as growing demand and inventory shortages were compounded by underlying price inflation. In addition to the substantial challenges posed by ongoing economic uncertainty, and they say climate change, the president's policies could further intensify the situation, potentially restricting development, altering affordability, and shifting market dynamics in unprecedented ways. Just like the inflation and the lockdowns. What to know? JP Morgan Chase's 2025 outlook published Monday says home prices are set to go up 3% in 2025, with the market itself expecting to remain largely frozen throughout the year. The company pointed out that illegal immigration in the U.S. could be ramping up housing demand more than figures suggest, resulting in a shortage of stock. One analyst noted that high interest rates have also created a divergence from existing homeowners to sell, worsening the dearth of supply. JP Morgan's report also pointed out to the exceptionally low levels of housing demand combined with rising prices. It said this indicates that there are enough homes available, but and that's a key word right there, but there may not be the right type in the right ideal location at an affordable price point. I respect that line right there. Thank God that they at least mentioned that. The pandemic and the increasing adoption of remote working fueled a wave of de-urbanization across the U.S., with former city residents migrating to less dense suburbs and smaller cities as a result. Beyond the pandemic impact of the administration's deportation plans on supply, JP Morgan Chase report said that several of Trump's proposals could, if implemented, lead to rising inflation, which is likely to result in higher mortgage rates that could further dampen housing demand. Other analysts have issued similar warnings regarding Trump's office's other policies. In a recent report, real estate brokerage Redfin said that the tariffs on imported goods, particularly construction materials, would have an inflationary impact, reducing housing supply and affordability. What people are saying, cutting immigration would mean cutting labor supply in the construction industry, which could end up exacerbating the lack of affordable housing. If you guys have been following the supply for new homes, you would know that that's far from the reality, because we have had over 6 months of supply for over 2 years, almost 3 years, and we're sitting at almost 9 months of supply, and that's underreported. And I know it's underreported because I look at the data and then I go to the subdivisions and I see for myself that it's underreported. Now, he added, it's evident that numerous aspects of Trump's policy would impact the housing market. For now, though, all we can do is wait. Housing market analyst Amy Nixon wrote on X this past October, we've added an estimated 4 million illegal immigrants since 2021 with Biden and Harris in office. A recent Zillow report says that the U.S. is short 4 million housing units. No need for mental gymnastics on what is happening and why. What happens next? As well as a 3% increase in home prices in 2025, JP Morgan Chase predicts mortgage rates will ease slightly to 6.7% from around 6.9% by the end of the year. So essentially, they're saying it's going to be flat the entire year. It's safe to say the reason for that is the inflation, and the inflation is killing us. It's extremely sticky and it's extremely hard to get rid of. But Mitch, can I get your reaction on the immigration situation and how immigration impacts the housing market, taking it into consideration that we've already reviewed with the viewers the Harvard report suggesting that the only growth in household formation for the next foreseeable future is specifically and solely from immigration. And we're going to remove the word illegal just to say less controversial.
That article is disingenuous, ignorant, and biased. There's not a stitch of truth in it. Can anybody explain to me how it is that an illegal immigrant, doesn't matter whether it's illegal, whatever, somebody comes in, okay, they don't have any money in their pocket, they have a reasonably low paying job, let's say $50,000 a year, is going to be able to afford a house of $300,000, even $225,000, which you can't find a house at that value in new construction? The answer is they can't, but for fraud. So whoever wrote the article is completely clueless and purely biased. First thing. The second thing is the fraud that's being paid in the system is levered money. It's your money, your real estate tax dollars levered up 20 times to 30 times, which means they've taken your future payments on your house, those real estate tax dollars, away from you for the next 20 to 30 years. It doesn't matter whether you're in a single family household or a multifamily household, the tax is getting paid one way or the other, pure fraud. That article completely ignores reality. You cannot sell a house to an immigrant, an illegal immigrant, call it whatever you want, a person off the street who cannot afford to pay for the house, but for the fraud. If they run the price up and then they buy down the mortgage, that's still part of the problem. You're putting people in housing that can't afford it. So the idea that you're short $4 million, whoever made that statement, you're an idiot. You're not short 4 million houses. We have excess inventory right now because of, well, we're going to have this amount of immigration coming in, and then we're going to have this amount of immigration going out. The immigrants couldn't afford it, regardless of what you label them. They couldn't afford it to begin with. Therefore, anybody that promotes this propaganda is culpable in hurting the exact people you claim and profess to be helping. You are a disingenuous liar, and I'm sorry, your news organization should have its doors chained shut. You're not allowed to do that. You are the ones that are affecting this market by hundreds of billions of dollars. These people can't afford it. You set them up for failure. You are culpable in their failing. I'm done.
Well, having said that, in other words, the housing market right now is incredibly toxic. If you're thinking about buying a house now or in the next year or two, or really anytime ever at all, just know, do not use your emotions. There is a way to navigate the housing market and not get absolutely bamboozled. There's a way to use math to calculate things like, is it a great deal from a wedge standpoint or buying from under market value? Or does the house have cash flow? Now, in my own market here in Houston, I can find all day, I can find houses with wedge, right? Currently wedge. If the market starts going down like crazy, then the wedge goes away. Now, the thing that I'm struggling with to find, though, in the markets is cash flow. And the reason for that is because the prices are absolutely skyrocketed. And especially here in Texas, the freaking fraud in regards to property tax. Either way, you guys, let's move on to our last segment and let's talk about the whole rate lock and golden handcuff phenomenon, and let's see where we're at. Here's the updated statistics on what homeowner has what interest rate. 17% of homeowners with mortgages have an interest rate of at least 6%. Now, that is the highest share in nearly a decade. Most homeowners still have a mortgage rate far below today's level, which is prompting many to stay put. But this lock-in effect is starting to ease because Americans are growing accustomed to elevated interest rates. And it doesn't say anything about prices, property taxes, it doesn't say anything about that. Just the interest rates, guys. Don't look at anything else here. Just the interest rates. That's all it's ever been about, Mitch. Just the interest rates. For many, it's not realistic to stay put forever. They're boosting listings and easing the housing shortage. Nationwide, 17.2% of U.S. homeowners with mortgages have an interest rate greater or equal to 6%. That's the highest share since 2016. That's up nearly 5% from 12.3% in the third quarter of 2023. So let's pause there a second. That means in 1 year that share has gone up 5%. I think it's going to go up more than 5% 1 year from now because turmoil is increasing and people don't have the excess savings that they once did. And a lot of people are now drowning in debt. If this growth rate were to continue, which is feasible, the share of homeowners with a rate of at least 6% would nearly double in the next 3 years. And I'm saying it's probably going to be more than that, especially with job loss and especially with the recession. Now, this is according to a Redfin analyst of data from the Federal Housing Finance Agency National Mortgage Database through the third quarter of 2024, the most recent period for which the data is available. We can see here, this is interesting. So the bottom line here, okay, that's a rate of under 3%. The blue line is 3 to 4%. The green line above that is 4 to 5. The orange is 5 to 6, and the red is above 6. So you can see we're entering levels kind of before we were at as far as pre-pandemic. In fact, if we look at pre-pandemic, the 6% is actually higher. The share of 6% is higher than where we were at pre-pandemic, at least again going back to about 2016, 2017. But I will also point out the biggest difference is the people with the low interest rates, specifically rates under 3%. I mean, we've never had this type of market share of rates under 3%. So yes, there are still this whole lock-in effect because there is a considerable amount of people, and let's see how many. Looks like 21%. So it looks like 21% of people with a mortgage right now have an interest rate under 3%. And I'm going to raise my hand because I am one of those people. America has been grappling with a severe housing shortage in part because the lock-in effect has decentivized people from putting their homes on the market for sale. Mortgage rates are now more than double the 2.65% record low hit during the pandemic. But for most people, it's not realistic to stay put forever, which is why the lock-in effect is easing. This is slowly changing the housing market shortage. New listings and active listings are both higher than they were a year ago. And that's really good because at first it wasn't like that. After the elections, immediately after the presidential elections, there was this period of optimism. And so those trends actually reversed. But now we're getting, again, an increase in acceleration of new listings, which is incredibly good. And that's what we'll see also potential distressed selling. Though it's worth noting that one reason supply is on the rise is that many homes are sitting on the market longer. So stale listings are piling up, which is good because generally the longer they're on the market, the more probable it is that you can make a lowball offer and get that accepted. Redfin agents report that many people are moving because a major life event like a job change or divorce has given them no other choice. So listen to that. So most people are moving because they have no other choice. Doesn't that mean that most of the current active listings are distressed sales? So what if we've had distressed sales this whole time, but just not enough of them? Isn't that probable? There are a few other reasons the lock-in effect is easing. One, many Americans are growing accustomed to the idea that rates are unlikely to fall to pandemic lows anytime soon. Number two, the pandemic surge in home values means many homeowners have enough equity to justify selling and taking on a higher interest rate, especially if they're downsizing or moving somewhere more affordable. And finally, a rising share of Americans are mortgage-free, which means they're not locked in at all. Here's the breakdown of today's homeowners and their current mortgage rates. So below 6% is 82.8% of people. Below 5% is 73% of mortgage holders. Below 4%, 55.2%. That's a crazy number, that 55.2% there. So 55% of people, mortgage rate under 4%. Mitch, when I say the lower that your rate was, so if I purchased a house in 2021 with the lowest interest rates, the lower that your rate was, the higher that your property tax and insurance went up. So the lower your rate was, the higher your property tax went up, and the higher that your homeowner's insurance went up. What do I mean when I say that?
I think it comes back to that Newsweek article in that the population, homeowners and multifamily renters are being manipulated. When you see an article like that, which is why I just went after it, what is the goal of that article? Well, if it is to push you into housing that you can't afford, or if I had a wish for everybody single family homeowner in the United States, it would be that they understood what their actual expenses are before they even bought the home. And I'm concerned that the manipulation that's in the system due to the fraud, because nobody wants to talk about the real estate tax, which is a fraud, obviously. We've proven that, and we're coming after it pretty hard in the next day or so with regard to who did it. We're naming names, et cetera, et cetera. The point is that if mom and pop are pushed because they don't understand a real budget or how to put that budget together or what the expenses are when you buy that house, you end up becoming a victim on something that, yes, caveat emptor, buyer beware, should be the case. But when multiple sources of the press are screaming at you, well, this housing inventory is this, and these immigrants are that, and this is going to cause damage over here, and we shouldn't be doing this, it's all wrong. The only thing that matters is the median household income. The only thing that matters is your personal income. Can your income pay for that $250,000, $300,000, $350,000 home, or whatever value the home is? If the answer is no, best not to be doing it, because you will be struggling for as long as you own that property, or as long as you are renting something that you cannot afford to rent. And that's why that line is now touching. The idea of owning a home versus renting is now touching each other. There's no value, there's no benefit. Yes, there would be a little bit of benefit in terms of size of the house, but in terms of cost of operation, these things are neck and neck at this point. The American dream has been stripped, and it's been stripped in favor of the leverage, and the leverage is the fraud, which was created at the school districts and the central appraisal districts. They're now neck and neck. The idea that you have to rely on the press is all the more reason to shut them off. Think it through. Are you being manipulated? Is somebody lying to you? You have to start thinking differently. And that's my wish, is that people don't get into these type of troubles, regardless of the interest rate. If you can't afford it, stay away from it. It isn't worth it.
Well, I mean, the other problem is, and this is kind of the reason why I asked this question. So say you got an interest rate in 2021 at 2.5%. Don't forget, in 2022 and 2023, your property taxes and insurance skyrocketed. So the lower the rate you got, the more it skyrocketed. If you're buying right now with these higher interest rates, at least you have the proper expectation, whereas these other people got absolutely blindsided. And another thing that brings me to the next thing. People are starting to realize, especially with this regret, that their affordability parameters change because your mortgage is adjustable. The only thing fixed on your mortgage is your principal and your interest. The property taxes are adjustable, homeowners insurance adjustable, HOA is adjustable, and don't forget maintenance and repairs. So people are starting to wake up to that fact. In other words, you guys be very careful. Don't rush it. I have a free home buying course. I'm also going to set up seminars to help teach you guys even more. And before I let him out of here, Mitch Vexler, how are we going to end this out? We're going to end this with some love, some optimism. Well, how are we going to end this, man?
The article that we're working on to the FBI and the SEC lays this case out. It literally says what the home affordability is, and it breaks it down to the median household income. That article says what it needs to say, as does the amicus brief and the bill that is now floating around somewhere in Austin. The point of the matter is these documents are accurate. We've asked multiple times over the last multiple months, if there's anything that we've said that is wrong or mathematically incorrect, please let us know. That was very sincere. We've asked. It's had over 5 million views, and so far, 0. We've had 2 people that said, well, I wish you weren't doing what you're doing, but they were real estate appraisers who make their money by getting a commission in between, trying to work with the CAD and the homeowner. So 2 out of 5 million, not so bad. Well, the point of the matter is what we have is accurate. We have the math, we have the law, we have the facts. What they have is fraud. What I am hopeful for is that mom and pop see the fraud for what it is and then take action in order to eliminate it, because their future has been levered 20-1 plus.
Yes, and we also have the links in the description for you guys to take a look at. So don't forget to do that. And don't forget to like the video, share the video, comment below. And other than that, if you guys are out there just living your life, investing in the stock market, investing in real estate, you guys already know we wish you luck and we hope you win.